What's good, guys? You're on FinInvest, and this is day two of our investment. Today, I'm going to talk about the investment itself, SQ2. So, I'll explain why I'm investing in the company. So, let's start. This is the screen where it shows the ASX, the Australian market. And my chain of thought, I had a look at the software. I saw the largest company, SQ2, clicked on it. I saw the projections, which are honestly crazy because if you see the price target is basically on the max, it's three times the current value, and on average, he predicts basically 100% growth if you look at the average. And obviously, I'm not going to trust some value on a random website, but it did make me look deeper into the company, and I truly believe the company is undervalued. So if we have a look first we have to start with the very simple. This is the website. This is where you can see the quarterly earning reports and the annual reports. We're going to start with the second quarter report because this is the most recent financial statement they have released. This is the investor presentation, and the company has been growing consistently. So basically, they have already grown 20% since the last second quarter. So there's consistent growth, which is great. The most important is this graph right here. They have started making money. Last year, if you see right here, they actually barely made any profit. This year, they're already beyond their last year's earnings, and they've already made $500 million just in 2 quarters. So now, also, if we have a look a little further down, the market opportunities. So what they're trying to say here is that actually we're just a bit of the market. We have tons of growth to do. Unlike many very large firms which already dominate the market and there's little room for growth in their original industry. This is not true for the company, as if we have a look here, the company has been focusing mainly on small businesses and micro businesses, which has seen that they actually do have a big portion of the industry. But now the new focus, the mid-market, the mid-sized businesses, the real money makers, they actually own a tiny portion. But now, since they've introduced many different financial tools, which we won't go in today, but we may have a look and actually pretend to be a customer and see how the company plays out and works with us. But for now, I just know that new financial tools means more potential customers for the bigger businesses, as they do require more than the small businesses. So this is great. They grow, they have where to grow, they started making money, which is really important. And this leads us on to the next thing. The big problem with the company last year, I'd say the biggest problem is actually that their earnings to market cap ratio, or PE ratio, is 101. So they need 100 annual incomes to pay for their market cap. And that's mainly due to them barely not being profitable. As if you look last year before that, they couldn't pay off their market cap because they were actually in the red. But this year, I've had a calculation. So there's my history. Obviously, I just combined the two quarterly reports, found the average, which is about $300 million, but we hope they're going to earn more than that. So they would probably, in pure profit, make about $1.3 billion, which means that their PE ratio will be 44, which is not great, but it's way better than the last year's one. Plus, considering that their stock is cheaper now, so it's basically you have more money. You have more money for a single share, even though the share is cheaper. So it's like getting a discount on something that's just getting better progressively. That's how I see it. And now, oh, bloody out. Now, if we have a look here, this is some more evidence on the revenue. On the revenue front, basically, they are consistently increasing their inflow. And the net income last year, if we have a look right here, it has been only $600 million. So according to our sort of conservative predictions, they will make at least double that. And they have already made almost this amount in 2 quarters. So even if they're like in the red for the next 2 quarters, which I don't believe will happen, their market evaluation should be the same as last year's, which means that the stock shouldn't grow nor fall. So I think this is as cheap as it's gonna get. Also, their assets to liabilities ratio, just to make sure. Their shareholder equity has been increasing, which means that their assets have increased faster than their liabilities. We could see right here they have $37 billion of assets. They have $18 billion of liabilities. The percentages don't matter because the values are much smaller. Now, next thing that I would like to talk about is the shareholders and the management. So I have mentioned Vanguard and Blackrock being the biggest investors for the company in the last video. Altogether, they own about 12% of the company, which is more than $6 billion. This is about $7-8 billion. And that's a huge bet. That's a big investment. And obviously, they are good investors. They are pretty smart. They hire the best of the best. So they do know something. Also, Jack Dorsey. I have mixed feelings about him as a CEO because he can make great companies. He has made several unicorn companies, multi-billion-dollar companies like Twitter, which is now X. Though he is famous for not making them profitable. As we all know, Twitter hasn't made any money, and Elon Musk tried to turn that around. But now, hopefully, Jack Dorsey realized his mistakes, and it does seem like he did because if we have a look again, the company has started making money, which may mean a turnaround in his mind or maybe the manager's mind. Also, very important to talk about the fall. So we all know the company has had the rough start to the year, losing huge amount. You can see right here. And that is mostly attributed to the management because the company has been making very useless purchases or sometimes really unfair, like afterpay, for which they have overpaid. You can have your own research, but they spend much more money than the afterpay was valued, which means that they did increase their market share, but it was not worth it. And also there has been purchases of companies such as a music company. I'm not too sure of its name. You can also have a research, but they've bought a music company which does not relate at all to finance and their industry. But that was all last year. Hopefully they have had a change in mind, which means that now they'll have proper growth only related to finance, none of that music shenanigans. And also hopefully they will keep on increasing their profits because they can't grow like 100x as they were like at the very beginning of the birth of the company. They have to make money to please investors, to please us. So yeah, this is it for now. But most importantly, last thing, for all of you who are interested to invest in the company, the November the 7th is the day of the third quarterly report. So this is where our predictions will be proven either true or false. So we predict that the company keep on making money, so high profits. The company will keep on consistently growing. I don't expect like explosive growth. All I care about is profits and consistency. And yeah, if it's not going to be proven true, we have to sell it on the day really quickly, otherwise we will lose money. So just write it in your notebooks, November 7th, the quarterly report. So that's it, guys. See ya.